If you're watching this video, you've likely noticed something unusual happening in the precious metals market. Silver prices have been making moves that have caught the attention of institutional investors, retail traders, and financial analysts worldwide. At the same time, banking institutions are facing pressures that haven't been this pronounced in over a decade. These aren't isolated events. What we're witnessing is the convergence of multiple economic forces that have been building beneath the surface for years. And whether you own silver, are considering entering this market, or simply want to understand what these developments mean for your broader financial positioning, you need to understand what's actually happening here. This isn't about chasing the latest market excitement. This isn't about getting rich quick. This is about understanding structural shifts in our financial system and positioning yourself with clear eyes and rational strategy. Let me be direct with you. The movements we're seeing in silver prices represent more than just another commodity rally. They reflect deeper anxieties about monetary policy, inflation persistence, industrial demand shifts, and most critically, questions about the stability of our banking infrastructure. When banks face pressure and precious metals rise simultaneously, we need to pay attention to what the market is telling us. But here's what concerns me most. Many people will react to these developments emotionally rather than strategically. They'll make decisions based on fear or greed rather than on sound analysis and proper risk management. Some will rush in without understanding what they're buying. Others will panic out of positions that might serve them well over time. My goal today is to help you avoid both mistakes. Over the next 25 minutes, we're going to examine exactly what's driving these silver price movements, why banks are struggling, how these factors connect to the broader macroeconomic environment, and most importantly, what rational strategies look like for different types of investors in this environment. This is complex material, but I'll explain it in plain language. You don't need a finance degree to understand what's happening. You just need to be willing to think clearly and set aside the emotional noise that dominates financial media. By the end of this video, you'll have a framework for understanding these developments, specific considerations for your own positioning, and a clear picture of the mistakes you absolutely must avoid. Let's begin. Before we can analyze what's happening now, we need to understand what silver actually represents in the financial system. Silver occupies a unique space. It's both a precious metal and an industrial commodity. This dual nature makes it fundamentally different from gold, and it's this difference that creates both opportunity and complexity. As a precious metal, silver serves as a store of value. Investors turn to it during periods of monetary uncertainty, inflation concerns, or financial system stress. It has thousands of years of history as money, and maintains its role as a hedge against currency devaluation. But unlike gold, silver has massive industrial applications. It's essential in solar panels, electric vehicles, electronics, medical equipment, and countless manufacturing processes. This industrial demand creates a floor under silver prices that doesn't exist for gold to the same degree. Why does this matter right now? Because we're facing simultaneous pressures on both sides of silver's identity. Monetary concerns are driving precious metal demand, while industrial transformation, particularly in green energy and technology, is driving industrial demand. When both forces push in the same direction, you get the kind of price movements that shock markets. Let's talk about something most analysts aren't emphasizing enough: silver supply constraints. Unlike gold, which is primarily mined for investment purposes, most silver comes as a byproduct of mining other metals like copper, lead, and zinc. This means silver production doesn't respond quickly to price signals. When silver prices rise, miners can't simply decide to produce more silver. They're constrained by the economics of the base metals they're actually mining. Additionally, silver mining is capital-intensive and time-consuming. From discovery to production, new mines can take 7 to 10 years to come online. This lag between demand increases and supply responses creates the conditions for sharp price movements. We're also seeing declining ore grades globally. Miners are extracting less silver per ton of ore than they were a decade ago, which means it costs more energy, labor, and capital to produce the same amount of metal. Here's the critical insight. When supply is relatively inelastic and demand increases from multiple sources simultaneously, prices must rise to clear the market. This isn't speculation. This is basic economics. Now let's turn to the banking sector, because understanding what's happening there is essential to understanding the broader picture. Banks are facing several concurrent pressures that haven't coincided like this in recent memory. First, there's the interest rate environment. After years of ultra-low rates, the rapid tightening cycle has created significant stress. Banks that loaded up on long-term bonds when rates were near zero are now sitting on portfolios with substantial unrealized losses. If they need to sell these assets to meet liquidity demands, those unrealized losses become very real. Second, deposit flight remains a concern. When rates were zero, there was no incentive to move money out of checking accounts. Now, with money market funds and treasury bills offering meaningful yields, depositors have options. Banks are competing for deposits in ways they haven't had to in 15 years. Third, and this is crucial, commercial real estate exposure is creating latent risk across the banking system. Office vacancy rates in major cities remain elevated. Work-from-home trends have permanently altered demand for commercial space. Many banks have significant loan portfolios backed by properties whose values have declined substantially. Fourth, regulatory scrutiny has intensified following the bank failures we saw in early 2023. Capital requirements are being reassessed. Stress testing has become more rigorous. This means banks have less flexibility to take risks or extend credit freely. What does this have to do with silver? Everything. When banking system stress increases, investors seek alternatives to bank deposits and bank-dependent assets. Precious metals become more attractive not because they generate yield, but because they represent value that exists outside the banking system entirely. You can hold physical silver without counterparty risk. You can't say that about a bank deposit. We need to address inflation directly because it's central to understanding current market dynamics. The official narrative has been that inflation is under control, declining back toward target levels. And in some measures, that's accurate. Year-over-year comparisons have moderated significantly from their peaks. But there's a difference between declining inflation rates and actual price stability. Prices haven't returned to pre-pandemic levels. They've simply stopped rising as quickly. If you experience 20% cumulative inflation and then inflation drops to 2%, your purchasing power is still impaired by that initial 20%. The damage has been done. Moreover, certain categories continue to see persistent price pressure. Food, energy, insurance, and housing costs remain elevated. These aren't abstract categories. These are the expenses that consume the majority of household budgets. Silver responds to both actual inflation and inflation expectations. When people doubt the official statistics or worry about future inflation waves, they allocate to hard assets. Silver, being more accessible price-wise than gold, often sees stronger retail demand in these environments. But here's what sophisticated investors understand. It's not just about inflation. It's about real interest rates. Real interest rates are nominal rates, minus inflation. When real rates are negative, meaning inflation exceeds the return you can get from safe assets like treasury bills, the opportunity cost of holding non-yielding assets like silver disappears. In fact, holding silver becomes rational because you're not giving up real returns to do so. We've had extended periods of negative real rates, and even as nominal rates have risen, real rates have remained relatively low in historical context. This environment favors hard assets over purely financial ones. Let's zoom out to the monetary policy picture, because these microfactors exist within a larger framework. Central banks globally have expanded their balance sheets dramatically over the past 15 years. The money supply has increased at rates that would have been considered reckless in previous eras. While much of this money creation didn't immediately flow into consumer price inflation due to velocity factors and debt dynamics, it has created asset inflation and a general sense that currency debasement is ongoing policy. When investors lose confidence in currency stability, they seek alternatives. Historically, precious metals have served this function. Silver, being more volatile than gold, tends to see exaggerated moves in both directions during these periods. There's also a geopolitical dimension worth considering. As international tensions rise and the weaponization of currency systems becomes more apparent, nations and investors alike are reconsidering their reliance on traditional reserve currencies and banking channels. This is driving interest in alternatives, including precious metals. China, in particular, has been a significant buyer of gold and has substantial industrial demand for silver. Russia has oriented away from dollar dependence. Other nations are exploring bilateral trade arrangements that bypass traditional currency mechanisms. These aren't fringe developments. These are structural shifts in the global monetary architecture. Silver may be a small market compared to major currencies or bond markets, but it's a market that investors can access directly, and in uncertain times, that accessibility matters. Now let's examine the industrial side of the equation, because this is where forward-looking investors need to focus. The global economy is undergoing a transformation in how energy is generated, stored, and utilized. Silver plays a crucial role in this transformation. Solar panels require silver for their photovoltaic cells. As solar installation continues to grow globally, driven by both economic factors and policy mandates, silver demand from this sector increases. Current estimates suggest solar applications now consume over 100 million ounces of silver annually, and this figure is projected to rise substantially. Electric vehicles use significantly more silver than traditional vehicles. The wiring, battery management systems, and charging infrastructure all require substantial silver content. As EV adoption accelerates, this becomes a meaningful demand driver. The broader electrification of the economy, from grid infrastructure to industrial processes to consumer electronics, all involves increased silver usage. We're not talking about marginal increases. We're talking about structural shifts in how economies function. Here's the challenge. This industrial demand isn't discretionary. These aren't applications where manufacturers can easily substitute other materials without significant cost or performance penalties. Silver's unique properties, its electrical conductivity, thermal conductivity, and reflectivity, make it essential for these applications. This means industrial demand is relatively price inelastic in the short to medium term. Manufacturers will pay higher prices because they have no choice. They need the silver to produce their goods. When you combine this inelastic industrial demand with investment demand driven by monetary concerns, you create the conditions for supply shortages and price volatility. To understand where we might be in the current cycle, we need historical perspective. Silver has experienced several major bull markets in modern history. In the late 1970s, silver rose from around $4 per ounce to over $50 per ounce at its peak in 1980, driven by inflation concerns, monetary instability, and the famous Hunt brothers attempted corner of the market. After a long bear market, silver rallied again from around $5 in 2003 to nearly $50 in 2011, driven by quantitative easing, sovereign debt concerns, and broad commodity strength. What followed was another extended bear market that didn't truly bottom until 2020, with silver testing levels around $12 per ounce during the pandemic crash. Since then, silver has been in a recovery phase with significant volatility but an overall upward trajectory. The question many investors are asking is whether we're in the early stages of another major bull market or merely experiencing a cyclical rally within a longer-term range. Here's what history teaches us. Silver bull markets tend to be driven by combinations of monetary distrust, inflation, and supply-demand imbalances. When all three factors align, moves can be dramatic and sustained. But history also teaches us that silver is brutally volatile. Drawdowns of 30-40% within ongoing bull markets are normal. Rallies can be followed by swift corrections that shake out weak hands. The metal doesn't move in a straight line, ever. The investors who succeeded in previous silver bull markets were those who understood they were holding a volatile asset for specific reasons, who sized their positions appropriately, and who didn't panic during inevitable corrections. We need to discuss how silver prices are actually determined, because this affects how the market behaves. Silver trades in multiple venues: physical markets, futures markets, options markets, and increasingly through various ETFs and digital platforms. The interaction between these markets creates complexity and sometimes disconnect between physical, supply-demand fundamentals and paper market pricing. The futures market, particularly COMEX silver futures, plays an outsized role in price discovery despite the fact that very little metal actually changes hands through physical delivery. Most contracts are settled in cash. This means that leverage and speculative positioning can drive prices in the short term, sometimes divorced from physical market realities. When large speculative positions unwind, you can see sharp price moves that don't reflect any change in actual supply or demand fundamentals. This is why silver can drop 10% in a day on no news. It's not always about the metal itself. It's about leveraged positions being liquidated. Understanding this market structure is essential because it explains why silver can seem irrational at times. The price you see isn't always purely a function of physical supply and demand. It's influenced by financial flows, leverage, sentiment, and technical factors. For long-term investors, this creates both challenge and opportunity. The challenge is enduring volatility that may not reflect fundamentals. The opportunity is being able to accumulate during periods when leverage-driven sell-offs push prices below fair value relative to fundamentals. Finally, we need to address why silver prices and banking stress often correlate. When systemic financial risk rises, precious metals benefit for a simple reason: they represent value outside the system. They're not someone else's liability. If you own physical silver, you own an asset outright. There's no counterparty that needs to remain solvent for your asset to maintain value. Banking stress reminds investors that deposits are bank liabilities, not assets. They're unsecured loans you've made to banks, backed only by the bank's solvency and deposit insurance up to certain limits. In times of genuine crisis, these distinctions matter enormously. This is why you often see precious metal buying accelerate when banking concerns emerge. It's not about silver being a great investment per se. It's about silver representing an alternative to financial system exposure. The current banking pressures may not rise to the level of system-wide crisis, but they're sufficient to remind investors that holding some wealth outside traditional financial plumbing isn't paranoid. It's prudent diversification. If you currently own silver, whether physical metal or through various investment vehicles, you're facing specific strategic considerations. First, revisit why you own silver in the first place. Were you buying it as an inflation hedge, a speculation on price appreciation, a component of a diversified portfolio, insurance against systemic risk? Your original reasoning should inform your current decision-making. If your thesis hasn't changed, there's no reason to alter your position based on short-term price movements, whether up or down. This is crucial. Price volatility doesn't invalidate a sound investment thesis unless the fundamentals have actually changed. Second, consider your position sizing. Silver should never represent such a large portion of your portfolio that its volatility causes you emotional distress or forces you to make decisions at inopportune times. A commonly cited range for precious metals allocation is 5 to 10% of investable assets, with silver potentially representing a portion of that. If recent price moves have pushed your silver holdings significantly above your intended allocation, rebalancing might be appropriate. This isn't about market timing. It's about maintaining the risk profile you've determined is right for your circumstances. Third, distinguish between tactical positions and strategic holdings. If you entered a silver position as a trade, expecting to profit from a specific move over a defined time frame, then you should have clear exit criteria. When those criteria are met, you execute. No second guessing, no hoping for more. If you hold silver as a long-term strategic position, as portfolio insurance or systematic diversification, then you should expect to hold through volatility. Strategic positions aren't traded based on price action. They're maintained as long as they serve their function in your overall portfolio. Fourth, evaluate your holding method. Physical silver provides maximum security from counterparty risk, but involves storage considerations and potential premium costs. ETFs provide liquidity and convenience, but reintroduce financial system exposure. Mining stocks provide leverage to silver prices, but also company-specific risk. Futures and options provide even more leverage, but are appropriate only for sophisticated traders. There's no single right answer. Each method has trade-offs. What matters is that your holding method aligns with your goals and risk tolerance. Fifth, resist the urge to obsessively track prices. This is psychological discipline, but it matters enormously. If you check silver prices multiple times daily, you're training your brain to react emotionally to volatility. This leads to impulsive decisions that undermine long-term strategy. If you own silver for sound reasons and your position is appropriately sized, checking prices weekly or even monthly is sufficient. You're not a day trader. You're a strategic investor. Act accordingly. Finally, consider tax implications before making any changes. If you hold physical silver or ETFs in taxable accounts, understand that gains are typically taxed as collectibles at higher rates than long-term capital gains. This means your after-tax return from selling may be significantly lower than the pre-tax price appreciation suggests. Sometimes the tax consequences argue for holding, even when you might otherwise consider selling. If you don't currently own silver but are considering entering this market given recent developments, your considerations are different. First, understand that you may be experiencing FOMO, fear of missing out. When prices rise sharply and media coverage increases, it's natural to feel like you should act quickly or you'll miss the opportunity. This feeling leads to some of the worst investment decisions people make. Chasing performance after significant moves is a recipe for buying near local tops and suffering through subsequent corrections. Breathe. There's no urgency here. Silver has existed as a market for thousands of years and will continue to exist. Missing a particular move doesn't mean you've missed the opportunity entirely. Second, determine what role silver would play in your portfolio. Are you adding it as diversification from financial assets, as an inflation hedge, as a speculation on industrial demand, as insurance against monetary instability? Your answer should influence how much you allocate and how you hold it. If you can't articulate a clear rationale for why silver belongs in your portfolio, don't buy it. Period. Every investment should serve a specific purpose in your overall financial strategy. Third, start small and scale deliberately. If you've decided silver has a place in your portfolio, there's no need to establish your full intended position immediately. Consider building your position over time, buying in increments regardless of price. This approach, called dollar cost averaging, removes the pressure of trying to time your entry perfectly. You might allocate 2% of your portfolio initially, observe how you react to the volatility, and add more if you're comfortable. This measured approach prevents regret whether prices rise or fall from your entry point. Fourth, educate yourself before buying. Understand the different ways to own silver and their respective trade-offs. If buying physical, understand premiums, storage, insurance, and liquidity considerations. If buying ETFs, understand their structure, fees, and counterparty exposure. If considering mining stocks, understand that they're equity investments with all the associated risks, not pure silver exposure. Don't buy anything you don't understand. This isn't about being cautious to the point of paralysis. It's about being responsible with your capital. Fifth, set clear expectations for volatility. Silver can easily move 5 to 10% in a week, and larger moves aren't uncommon during periods of high volatility. If this kind of price action would cause you anxiety or lead you to sell impulsively, silver may not be appropriate for you regardless of its fundamental merits. Your psychological tolerance for volatility is as important as your financial capacity for risk. Be honest with yourself about both. Sixth, ignore short-term narratives and focus on longer-term factors. The financial media will provide you with new explanations for every price movement. Today's explanation for rising prices will be forgotten tomorrow when different factors dominate. Don't let this noise affect your strategy. What matters are the longer-term supply-demand fundamentals, the monetary environment, and silver's role in your portfolio. Those factors change slowly. Everything else is just noise. Regardless of whether you currently own silver or are considering a position, certain principles apply universally. Never invest money you need in the near term. Silver is a long-term holding, not a place for funds you might need in the next year or two. The volatility means you could face significant paper losses at precisely the moment you need liquidity. Only invest capital you can afford to tie up for extended periods. Avoid leverage unless you're a sophisticated trader with extensive experience. The temptation to use options, futures, or margin to amplify your exposure is strong, especially when prices are rising. Resist. Leverage transforms a volatile asset into a potentially account-destroying one. Most people who use leverage in commodities eventually suffer catastrophic losses. Don't become a statistic. Maintain broader portfolio diversification. Silver should be one component of a diversified portfolio, not your entire strategy. You should own a mix of assets that perform differently under various economic scenarios. Silver may be rising now, but other assets may outperform in different environments. Diversification isn't about maximizing returns. It's about managing risk. Keep emergency liquidity separate. Before investing in any volatile asset like silver, ensure you have adequate emergency funds in highly liquid, stable accounts. This foundation allows you to hold through volatility without being forced to sell at inopportune times. Now I need to address the behavioral mistakes that destroy capital during periods like these. Pay attention here because these warnings are based on observing countless investors make the same errors repeatedly. The biggest mistake new investors make is buying after significant price rises because they see something moving and assume it will continue. This is gambling, not investing. Momentum works until it doesn't, and reversals are often sudden and brutal. If you didn't have a thesis for owning silver before prices rose, you shouldn't buy just because they have. Some investors, excited by price movements or convinced by persuasive narratives, put far too much of their portfolio into silver. They reason that if a small position is good, a large position must be better. This is catastrophically wrong. Proper position sizing is perhaps the most important risk management tool you have. Concentrate too heavily in any volatile asset, and you'll eventually face losses you cannot psychologically or financially endure. Emotional trading, buying when you feel excited and selling when you feel afraid, is the most reliable way to lose money in volatile markets. Prices will fluctuate. There will be days when silver drops 5%. There will be weeks when it feels like it will never stop falling. If you sell during these periods out of fear, you lock in losses and position yourself to miss the recovery. Conversely, buying at tops because you're excited about price action means buying expensive. Discipline beats emotion, always. I mentioned this earlier, but it bears repeating with emphasis. Futures, options, and leveraged ETFs are sophisticated tools that can amplify losses as easily as gains. Unless you have extensive experience and truly understand these instruments, avoid them entirely. The stories of people making fortunes with leverage are vastly outnumbered by stories of people losing everything. You just don't hear about the latter as often. I've seen investors become so focused on silver or other investments that they neglect basic financial hygiene. They carry high-interest debt while speculating in volatile assets. They have no emergency fund, but own silver coins. They ignore retirement account optimization while trading commodity ETFs. This is backwards. Handle fundamentals first. Eliminate high-interest debt, build emergency reserves, maximize retirement contributions, insure appropriately. Only then should you consider allocating to volatile assets like silver. Anyone who tells you silver is definitely going to some specific price is either delusional or selling you something. The future is uncertain. Markets are complex adaptive systems that don't move in predictable ways. Silver could rise substantially from here. It could fall substantially. It could trade sideways for years. Anyone claiming to know with certainty is not to be trusted. Make decisions based on probabilities and risk management, never on someone else's certainty. In taxable accounts, precious metals are typically taxed as collectibles, with gains taxed at your ordinary income rate up to 28%, rather than the lower long-term capital gains rates that apply to most investments. This substantially reduces your after-tax returns. Factor this into your decision-making. Sometimes the tax treatment makes alternatives more attractive than they initially appear. Silver will correct. It always does. Sharp sell-offs are part of owning this asset. If you panic and sell during these corrections, you'll consistently sell near bottoms and miss the subsequent recoveries. Volatility is the price you pay for silver's potential benefits. If you can't tolerate the volatility, you shouldn't own the asset in the first place. Markets evolve, economic conditions change. What worked in past cycles may not work in future ones. The investors who succeed long-term are those who remain students of markets, who read widely, who question their assumptions, and who adapt their strategies as conditions warrant. Never assume you know everything. Arrogance is expensive in financial markets. Let me bring this together for you. We're experiencing an unusual confluence of factors in both precious metals markets and the banking sector. Silver prices are responding to real supply-demand pressures, industrial transformation, and monetary uncertainties. Banks are navigating challenges that require careful management and have implications for the broader financial system. These developments matter, but they don't require panic or impulsive action. What they require is clear thinking, rational strategy, and disciplined execution. If you own silver for sound reasons and your position is appropriately sized, maintain your discipline. Don't let price volatility dictate your actions. Trust your analysis and stay the course. If you're considering a silver position, move deliberately. Start small, educate yourself thoroughly, and focus on long-term fundamentals rather than short-term price action. Build your position over time if it makes sense for your circumstances. Whether you own silver or not, maintain a diversified portfolio, keep adequate liquidity, avoid leverage, and never invest money you cannot afford to lose or tie up for extended periods. The investors who thrive during periods of market volatility aren't those with the highest conviction or the biggest bets. They're those with clear strategies, appropriate risk management, and the emotional discipline to execute their plans regardless of market noise. You don't need to predict the future perfectly to succeed financially. You need to understand the present clearly, position yourself sensibly for a range of possible futures, and maintain the discipline to stick with sound strategy through inevitable volatility. Silver may rise substantially from here. It may fall. More likely, it will do both, multiple times, in ways that surprise most observers. What matters isn't predicting these moves. What matters is having a clear framework for decision-making that serves you regardless of what happens next. The fundamentals we've discussed, supply constraints, industrial demand transformation, monetary policy uncertainties, banking system pressures, these aren't going away quickly. They're structural factors that will influence markets for years to come. Understanding them positions you to make better decisions, not just about silver, but about your broader financial strategy. This is a long game. Success comes from patience, discipline, and rational analysis, not from trying to catch every move or maximize every opportunity. Some opportunities you'll miss, some positions will frustrate you with their volatility. That's fine. What's not fine is letting emotion override strategy or taking risks you can't afford. Remember, the goal isn't to get rich quickly. The goal is to build and preserve wealth systematically over time, positioning yourself to weather various economic environments while